In this video, I'm gonna walk you through how you can analyze a storage deal in 7 minutes or less, even if you're just getting started, so that you can avoid bad deals, spot great ones, and feel confident moving forward. So the idea here is if you are trying to buy your first facility or your next one, you don't need to be a CPA or a spreadsheet wizard, but you do need to have a pretty firm understanding of how to analyze a deal and analyze a deal fast, because look, if the numbers don't work, then nothing else matters. And really, by the end of this video, I want to equip you and give you the confidence to be able to do a back of the napkin analysis within 7 minutes or less to determine, should I pass go and collect $200 and move on to deeper underwriting, and really giving you the confidence to have a conversation with the seller and see if you're even in the ballpark. Now, I think it's first, before we talk about underwriting, right? Analyzing a deal. I think that word underwriting is thrown around so much in the industry. And you might be sitting here thinking to yourself, like, Alex, what in the world is underwriting? Look, underwriting it's basically just a financial analysis of a property, right? So it's everything from what are you going to pay for the facility? What's the down payment? How much revenue or income is the facility generating? What are the operating costs? Things like taxes, insurance, management, etc. What is the structure of the debt, right? How much are you paying to a bank, a lender, things of that nature? And then ultimately, how much cash is left over? So when we talk about underwriting, just think of a financial analysis of a piece of real estate, right? And it's so important that you know your numbers, because lenders care about the numbers, investors care about the numbers, you need to care about the numbers, because let's be honest, we're not going out and trying to buy storage facilities because it's a hobby, right? We're doing it so that we can make money, we can have cash flow, which is going to give us more financial freedom, time freedom, allow you to do the things that are most important with you and your loved ones, and live life, because as cliche as it sounds, we only get one opportunity. And so we need to maximize that. And storage, in my opinion, is the best asset class within real estate to help you do that. So bottom line is, underwriting tells you one thing: is the deal worth pursuing further? Now, I will say that one of the things I always share with my Storage Wins members and our community is, if the deal doesn't make sense, don't just stop there, but ask yourself, what would make this a deal? And that could be a lower price, that could be really, really good terms. I've done videos on the YouTube channel here about how to structure terms offers and seller financing, but we're not going to get into that now. So now that we have a pretty general understanding of what underwriting even means, I think the first thing to do is we got to start with the income, right? It all starts with the current income. Now, there's a big difference between current income and GPI, gross potential income. If you were to jump on Crexi or LoopNet right now, you're going to see offering memorandums that brokers are providing on the different storage facilities that are on the market for sale. And most of the time, these brokers are pushing GPI, gross potential income, essentially pro forma. It's saying, hey, this is what the facility could or will be doing in the future once you raise the rates, once you do X, Y, Z. But when I look at deals, I always start with the current income, right? What is all the income that facility is currently generating? Now, and that's not just rent, by the way, but that's fee income, right? That's just one of the reasons I love storage, is because we have things like admin fees and clean out fees and auction and tenant protection and 24/7 access fees, right? So it's all the income, all the revenue that facility is producing. That starts at the top, right? And then we look at actuals and we verify it. We're not buying based on fantasy. We're not buying based on pro forma. We're buying on what it's actually doing today. And yes, I might factor in, I'm going to certainly look at what it could be doing and what the upside is, but my offer is not going to be based purely on pro forma or what the upside is. I might factor a little bit into that, but my offer is going to be heavily weighted on what it's currently doing. So we're buying based on facts and what the facility is producing now. Oftentimes you'll find sellers that want a price based on future income, pro forma. And if they want that price, then they need to do the work to increase the revenue and the overall value of that facility, right? So we start with revenue, and then we have to look at all the operating expenses that it takes to run, manage, and operate that storage facility. So in storage, I would say that the general rule of thumb is operating expense ratio is going to fall anywhere between 30 and 40%. Now, look, I have some friends that are really, really dialed in. They do in-house management, so their operating expenses are lower, and they might be able to manage a facility at 26, 27, 28% operating expense ratio. That's certainly not impossible. I would never underwrite a deal basing it on such a low operating expense ratio. I typically, depending on the size of the facility, right? If it's a larger facility, then you're going to get compression on the operating expense ratio, meaning that you might be able to operate that facility for 30 to 35% operating expense ratio because you get leverage, because you get economies of scale. Now, if it's a really, really small facility, then I'm probably looking at closer to like a 40% operating expense ratio. So when you think about expenses, that's going to be everything from your property taxes, insurance, management, right? If you're using third-party management, or even if you're self-managing, you need to budget anywhere between 5 and 10%, depending on the size of the facility. In storage, typically we don't have like utilities unless you have a climate-controlled building. You might have, obviously you're going to have internet, things of that nature. If you're in the Midwest or somewhere where it snows, you're going to have snow removal, trash removal, things of that nature, bookkeeping software, your boots on the ground. So all the different operating expenses. So you take revenue minus your expenses, and that's going to give you your NOI, otherwise known as the net operating income. Now, it's super important to understand that the NOI, the net operating income, does not take into account any debt service. So if you went out and you got a bank loan, or if you raised money from private lenders, the NOI hasn't even factored in your debt service payments. In order to get to cash flow and figure out how much money you're going to be making, now that's when you take your NOI minus all of your debt service, and then that's going to give you your cash flow. And look, you really need to understand when you're looking at a storage facility, what are your goals? Is your primary goal cash flow? Is your primary goal the future equity and the upside of the facility? You can certainly have both in a deal, but my opinion is you need to have a primary objective, because that will determine if that particular deal makes sense for you, what you should offer, and how you should structure that deal. So just quick recap. NOI, the net operating income, basically tells you what the business makes before paying any banks, lenders, or taking into account any debt service. Once you subtract your loan payments, your loan payments is the debt service. What's left over is the cash flow. Now, I wanna go ahead and offer you 100% free, just for watching and being a supporter of the channel, the podcast, and just following my content. If you want our Storage Wins quick offer calculator, then go ahead, and there's going to be a link right below here where all you got to do is put your name and email, and you can get access to our quick offer calculator, which essentially is designed and created to be able to give you an offer range based on the current income or the current revenue that facility is generating. Now, something that it takes into account is called the cap rate. And in a few minutes, I'm gonna explain to you in just layman's terms what is a cap rate. But something that I really wanna touch on that's so important is banks are always gonna look at something called the debt service coverage ratio, otherwise known as DSCR, the debt service coverage ratio. Now, the debt service coverage ratio basically tells a bank, based on the income that this asset is producing, what is its ability to repay this debt. So as an example, if you have a storage facility that's generating $100,000 in net operating income, $100K in NOI, and the annual debt service is $100K, $100,000 NOI divided by $100,000 in debt service, that's a break even. That's a debt service coverage ratio of 1. Now, most banks are going to want a DSCR, a debt service coverage ratio of between 1.2 and 1.3. That is a healthy indicator of a facility's ability to comfortably repay that bank. And let's be honest, banks are, they're in the business of lending money but mitigating risk. And they want to feel comfortable that you as the operator and the business can be able to support that debt service and pay it comfortably. So when you look at deals, you want to make sure that based on the net operating income and based on the annual debt service, that when you divide those numbers, you're at least 1.2, if not greater. If you're not at 1.2, then it may mean it's either not worth continuing or you got to really work the numbers. And I don't ever just discard something because initially the numbers don't work. But again, I ask myself, what would make this a deal? And is it price? Is it terms? Is it a combination? So if the facility isn't generating enough income to comfortably cover the debt, it probably means that the way it's currently structured at the current price, it's just not bankable, okay? Now, let me go ahead and talk about cap rates before we start to wind this down. Look, a cap rate, basically in layman's terms, it's just the return on the investment that you would get if you were to buy the facility cash. It's an overall expression of value. And I know what you're thinking, hey, Alex, easy for you to say, like, I'm not gonna be buying the facility cash. Whenever I underwrite and look at a deal, I just look at the cap rate based on if I was gonna buy it cash, and then I'm gonna factor in debt service and see what it does to the numbers. But it's so important that you understand that cap rates is not the end all be all. So I think so often, especially newer storage investors, they put so much emphasis and value on the cap rate. And cap rates vary by market, right? The cap rate here in Miami is going to be significantly lower than the cap rate in a tertiary market somewhere in the Midwest, right? So bigger metropolitan cities, you're going to have a low cap rate. Tertiary, smaller markets, you're going to have a high cap rate. Just like if you have a brand new facility, it's likely going to have a lower cap rate. If you have an older facility with some deferred maintenance in a small town, it's going to be a high cap rate. So look, inside the Storage Wins offer calculator, all you got to do is if you get the current income that the facility is producing, you just plug that number in, and based on a certain cap rate range, it's going to give you an offer range. So as an example, if a facility is generating $80,000 in net operating income, at an 8 cap, so if you were to take $80,000 divided by 0.08 or divided by 8%, that means that you could offer $1 million if you wanted an 8% return, right? At a 10 cap, that number would be 800,000. At a 12 cap, that number would be 667,000. So the calculator does all the heavy lifting for you so that you don't have to crunch this. Really, the idea here is just to give you an offer range to enter into the negotiation to see if you're even in the ballpark of what the seller would want and expect so that you're not overthinking it. When we officially put an offer in writing, we'll take it into a further underwriting model and a deeper spreadsheet that we offer within our community. So this really is just to be able to give you a quick test, a back of the napkin analysis so that you know how to underwrite and analyze a storage deal in 7 minutes or less. And I know that the title of this is in 7 minutes or less. The truth is this can be done in just a minute or two, right? Especially once you understand how to work it. So hopefully this gives you confidence to be able to look at a storage facility, plug in a number or two and just say, hey, is it worth diving deeper, right? And if it's not, then asking yourself, okay, well, what could I tweak or what would need to change in order to make this a potential deal? That's so important. So with that being said, if you want the Storage Wins quick offer calculator, there's going to be a link below where you can check that out. You can get it 100% for free, just my gift to you. And if you want our full underwriting model, the spreadsheet, that goes a lot deeper and covers things like cash on cash returns, investor returns, the debt service coverage ratio, like all the important financial metrics. And if you want to surround yourself with a community of like-minded people that are all after building a storage business that can give them more time freedom, financial freedom, I want to encourage you to check out storagewins.com. Again, there'll be a link below, storagewins.com. And with that being said, I look forward to catching you on the next one.